Tonight, our stock market wizard, Roger Montgomery
from Richard Puntillo, said this. In theory, publicly traded corporations have shareholders as their kings, boards of directors as the sword-wielding knights who protect the shareholders, and managers as the vassals who carry out orders.
That makes sense.
In practice, in the past decade, managers have become kings who lavish gold upon themselves, boards of directors have become fawning courtiers who take coin in return for an uncritical yes-man function, and shareholders have become peasants whose property may be seized at management's whim. Isn't that brilliant?
It is. And
I'm sure there are a bunch of viewers watching the program who are shareholders who probably feel that that's true.
Yeah.
Okay, so
are you going to name the companies where you think that actually happens?
I'm going to mention two companies in the context of their mergers and acquisition strategies.
Okay. All right.
In their quest that, bigger is better, they've destroyed a lot of wealth.
Okay.
And Australia has a very patchy record on mergers and acquisitions. Sometimes they make the right synergistic acquisitions, the businesses that fit with their businesses, but inevitably my research suggests that they've paid far too much, and I'm going to use two examples to demonstrate that.
What was the best one, Roger?
Many
what was
more.
the best one? Like you must
QBE consistently makes acquisitions at the right price and does reasonably well.
And then these seamless. You forget who they took over, don't you?
Yeah, that's right. They seem to fit them in and they seem to work.
Okay.
But that's not the case with most of Australia. In fact, I like to think there's a graveyard, and to get into the graveyard you have to overpay for an acquisition, and there are equity capital markets executives standing at the gates clipping the ticket as everyone comes in.
Now I don't know what companies you're going to talk about.
Sure.
Is AMP and AXA going to be one of those?
AMP and AXA will be the last example because it's a fairly recent one. Right. But yes, it is there.
It's an interesting one. Yeah.
We'll talk about that. Okay, so the first one I want to talk about. Actually, before we do that, Simon was just on the program, and I like Simon. He and I are friends, and he was talking about Fairfax. One of the things that he didn't mention that I think is really important to have a look at is the fact that on their balance sheet they got between $2 and $3 billion of goodwill, intangibles, goodwill. Now, what's goodwill? When a company buys another company, the amount of money that they pay over and above the market value of the tangible assets is called goodwill. Yeah. So if they've got desks and tables and computers and they amount to $1 billion, but they pay $2 billion for it, well, there'll be $1 billion on top of the billion of accounting goodwill. Yeah. Now, that's an accounting construct. Accountants have just thought, well, what do we call this amount? We'll call it goodwill. Really, it should be called, oops, I paid too much.
Okay.
So that's what it should be called.
You're not prepared to say the extra billion is the value of the Fairfax name, that you whack a Fairfax thing on something?
There's some of it there, some of it is that, but a lot of it is accounting goodwill for the overpayment of acquisitions. Yeah. Why do I say it's overpayment? Well, if you take that goodwill into account and you've got your equity figures, so you take all the assets, including the goodwill, you subtract the debt, you're ending up with equity. If you compare the profits to that equity, you end up with a return on equity of about 3 or 4%. Now, that's less than what you and I can get in a term deposit. So arguably, that goodwill shouldn't be there at that amount. The auditors should come in and write it down because that is a non-economic rate of return on equity. If I said to you, I want you to invest $2 billion in a business and we're going to get 3 or 4%, you'd say, Rod, you're crazy, I'm not going to do it. Right? So arguably, you wouldn't pay that much. Therefore, that goodwill shouldn't be on there at that amount. So in addition to all the things that Simon said, Warren Buffett once said that, that newspapers were the toll road, and everyone who wanted to sell anything had to do it in the classifieds of a newspaper. Well, more recently, Buffett's come out and said, I wouldn't pay any price for a newspaper now. And that's backing up the things that Simon said.
Superhighway. That's
exactly. So let's talk about some companies. The first one I want to talk about is Foster's, and I think a chart of Foster's is going to come up in a moment. I rank companies from A1 to C5. Foster's is a C5. It gets the lowest possible ranking I can give a company in terms of its quality of the balance sheet and its performance. In 2001, the intrinsic value of Foster's was $2.99.
Yep.
Last year, 2010, intrinsic value was $3.50. So it's grown its intrinsic value by 1.6% per annum. It's negligible. You wouldn't buy a business. Now, that's reflected in the share price. Share price was $5.71 10 years ago, and it's $5.51 now. Share price hasn't moved. Price follows value.
Yeah.
So Benjamin Graham talked about that. Now, what did they do? What did they do wrong? Well, they bought South Corp.
Yep.
They bought South Corp for $3.1 billion. The initial bid was $4.17 a share, and they then eventually paid $4.26 a share. Private equity, after they bid for it, now at that time, South Corp earned, the year before, it earned $46 million profit on $1.1 billion of revenue. Now that profit of $46 million was the same as the profit 10 years before. So in 10 years, South Corp's profit hadn't changed, and the company, and Foster's came out and paid $3.1 billion for it.
It should have paid a lot lower on those figures.
And you can do this. What I've done is I've put this on my blog, all these numbers on my blog, so people can come on there and use the tables in my book and do this calculation themselves. So if they use a 5% return on equity, which is a little bit higher than what South Corp was actually generating, a 12% required return, so the return that they want on their money, $1.17 of equity and a 61% payout ratio. They're all the numbers from South Corp at the time.
Yep.
I got a value of 59 cents. Now the shares were trading at $4.28, and an independent expert came out and said they were worth more than $5, and that Foster's bid should have been rejected. And I got 59 cents. Now, if I'd come on the show at the time and South Corp was being bid for by Foster's at $4.17 and the share price was $4.28, and I said, mate, it's worth 59 cents, you would have said, Rog, you're crazy. So since then, what's happened? What's happened? Private equity offered $2 billion for the wine business, and Foster said, no, it undervalues it. They've now spun it off. They spun it off last week, and they've written down $3.5 billion from that acquisition alone.
Okay. Now, great point, but you often will ignore other issues. Now, one issue that's really important to that business is the exchange rate. Because when the Australian dollar's at 57 cents, it's a lot. You've got a much more valuable wine business.
So what you're saying to me, what should have happened is that they were justified in paying $3.1 billion and hoped that the Aussie dollar halved.
Oh, no,
and then they would have done okay.
No, I'm saying that, but sometimes decisions are made on the supposition that an exchange rate will stay where it is.
Well, that's never going to happen. When has the exchange rate ever stayed where it is?
All that stuff is correct. But I agree. But sometimes something can look really valuable, and there were a lot of wine businesses that were very valuable when the currency was low. Well, let's talk
about that.
Like
there were lots of takeovers going on at that time internationally, and there were rumours about it. And since then, a whole bunch of businesses have gone to the wall. Evans and Tate, Xanadu, and a whole bunch of them. And what's really interesting is that using the numbers at the time, and remember there was a long track record at South Corp about its performance. You could have used that track record and said, well, assuming that continues, it's worth 59 cents. I agree with you. Maybe Foster's could have justified a higher price by saying, well, we're going to do a better job. We'll pay a bit more.
Yeah, and we have the better links to the sellers.
Should they have paid 8 times more than 59 cents, which is the value based on the performance at the time? No.
And we're running out of time. Go to the next one quickly.
Very quick one. PaperlinX, a B2. Back in 2003, September 2003, they bid $1.1 billion for Berman Paper, the European mob. They borrowed $900 million and they issued $150 million worth of shares. The share price at the time was $3.77. The company came out and said this is going to be earnings per share accretive and so on and so forth. 10 days later, the shares were trading at $4.93. This is PaperlinX's shares. They went up to $4.93. Now, I had a value of $2.50 at the time. And when they made that acquisition, looking back then, using my approach, the value dropped from $2.50 to $1.83. Now, what's happened to the intrinsic value since then for PaperlinX? It's fallen from $2.50 to 17 cents. It's declined 23% per annum. The share price has gone from that $4.93 euphoric response to the takeover, and it's now trading at 28 cents.
And so the
share price follows the value.
And the moral of the story is be very careful of a company that goes for a very big merger and acquisition.
If you own a company that is making an acquisition for another it's making an acquisition, get this valuation technique off the blog and apply it to the company being bid for.
And next time we come on the program, let's start off and look at AMP and AXA, because a lot of people are AMP shareholders.
Can I do one more? We've got 1 second. One second. Really quick. Zinifex and Oxiana. Remember they merged to form Oz Minerals? The combined market capitalisation of those two companies at the time was $10 billion. Market cap now together, $4.6 billion.
Yeah.